mean, Keynesianism is based on emotion. It's based on feelings. It's based on, doing what sounds right and making yourself feel good. You can feel better about yourself if you support all sorts of government programs without actually understanding the effect of the programs, that they actually backfire and they achieve the opposite of what their intended goal is. But liberals don't think these things out, right? They think with their hearts, and they ignore all the anecdotal evidence that shows that what they believe is wrong, because they're very closed-minded. And then they believe that people like myself or conservatives or libertarians that don't support these programs, they just believe they're bad people, that they're mean or they're evil. And they don't understand that it's just their own naivete. The people that don't support these programs don't do it out of meanness. It's because they actually understand the unintended consequences that the liberals ignore. If you're a long-term guy, and that's what you have to be to allow these cycles to play out, in the short run, it can be very difficult because you're going against the herd. I mean, in the short run, it's not who's right that makes money. It's just who's got the numbers, right? In the long run, the markets are a weighing machine, but in the short run, they're a voting machine. And if more people are fooled by government policy and Fed policy, and they're doing one thing and you're doing the opposite because you understand the long-term effect of these policies, it can make it hard because you could be wrong for a long time on paper before you're proven right. And a lot of investors don't have the fortitude, don't have the long-term time horizon to ride it out. I mean, I've got the same thing going on now with a lot of my clients who, have been closing accounts with me to invest in the U.S. stock market, which I think is a crazy thing to be doing, especially since, we've outperformed the U.S. market for all of 2017 and all of 2016. But over the last 5 years, we haven't done that. And that's because from 2013 through the end of 2015, not only did you have a U.S. stock market bubble, but you had a dollar bubble. And so that suppressed returns on overseas investments, on commodity-related investments, emerging markets, on gold. And so over that 5-year period, yes, people would have been better off investing in the U.S. market than investing abroad with me. But the game isn't over. The U.S. stock market is a bubble that's in search of a pin, and it should have popped a while ago. The dollar is an even bigger bubble. And people that understand this understand how much money is going to be made by taking the other side of this trade. When the air comes out of this bubble, when the dollar reverses and surrenders all these ill-gotten gains, and in fact, it's going to move to all-time record lows. And when the U.S. stock market starts to turn lower, as foreign markets decouple and move higher, then all of a sudden the people who have understood the error of these policies are going to get paid, and they're going to get paid in a big way. Just like we got paid for shorting the subprime mortgage market. I mean, that trade took years to play out. I mean, I was warning about the housing bubble since the Fed first started inflating it in 2002. I started writing my book about the housing bubble in 2005. In fact, the original title of my book, Crash Proof, it was going to be all about the housing bubble and, the coming American nightmare. But I ended up just condensing the housing part into a chapter and writing a broader book. But I saw this bubble from a mile away, yet it wasn't until 2007 that the air came out. And so right now you have a lot of people that are in the U.S. stock market that think they have a lot of profits. They don't have anything. They haven't sold. They have the opportunity to make a profit, but they may not. And the Fed has actually blown 3 enormous bubbles during this cycle. They blew up a bubble in the 1990s. When that one popped, the market lost half its value. Then they blew up another bubble. That popped in 2008. The market lost half its value. Now the Fed has blown a third bubble, right? This is the biggest one yet. Now, if it just repeats what the last one did, it's going to lose half its value again. But the risk is, what if the Fed can't come to the rescue again with an even bigger bubble? What if the third time's not the charm, right? What if it's 3 strikes, you're out, right? People think, the Fed's going to make it a hat trick. No, I think there's a good chance that the next time the market goes down, it goes down for the count. Because I don't know that there's a bigger bubble the Fed could blow. This could be it. This could be the last bubble they ever blow because it's the biggest one yet. And when the air comes out, I don't think there's any way to reflate another one. The only thing they can do is completely destroy the dollar. And if they succeed in doing that, which means they create a currency crisis and a sovereign debt crisis, I mean, a crisis in the treasury market, not in the mortgage market, that's going to lead to something much worse than a financial crisis. But if they don't do that, because they don't want the dollar to, become monopoly money, then we're going to have a much worse financial crisis than the one we had in 2008. The stock market may not decline. by 50%. I mean, the Fed can stop it if it prints enough money, right? So, because what happens is instead of the market falling, the dollar falls. And if you're measuring the value of stocks in dollars, it's all relative. So if the dollar is losing value faster than stocks, stocks can go up in nominal terms, even as they're falling in real terms. So I own gold because of inflation, not because of deflation. It's because I don't believe that the central bankers have the guts or the integrity to allow the bubbles to deflate. I think they're going to continue to print money. I think they're going to sacrifice the dollar to prop up the stock market, to prop up the real estate market, to prop up the bond market. That's why we might not get another 50% correction in the stock market. Because again, if we do that, there's no way the Fed can reflate this bubble. There's no way that they can bail us out of the ensuing financial crisis. And because this bubble may literally be too big to pop, the Fed may be, try to keep as much air in it as possible. And of course, as soon as it looks like the economy is really turning down or the market starts to go down again, they slash rates and they launch QE4. And of course, since they're cutting rates from a very low level, there's not a lot of stimulus. They're going to really have to provide the stimulus through the quantitative easing, which really isn't a stimulus, it's a sedative. And I think it's going to be a lethal dose. I think we're going to overdose on the stimulus, and that's where the bottom really drops out of the dollar. I mean, the dollar was, on its way to a collapse in 2008 before the financial crisis. Ironically, the financial crisis actually saved the dollar. Right? It bought the dollar a lot of time. It was at an all-time record low. Right, the dollar index was about 70, and the financial crisis came, and people didn't know how to react, and they all, bought dollars. But then once the Fed showed its cards with QE1 and what they were doing, the dollar started to fall. And it's my opinion that the dollar would have cracked and made a new low had it not been for the efforts of foreign central banks. If you remember, they called it currency wars, and all these other central banks kept printing money because they were panicking that the dollar was going to keep falling, and they were worried about their exports to the United States. So they print all this money, and that's what stopped the dollar from making a new low. But then the dollar caught a bid from the perception that all of a sudden everything worked. All the fears about hyperinflation, all the guys like Peter Schiff, we were all wrong. These guys are geniuses. They saved it. Everything is perfect. Now they're going to unwind the balance sheet. They're going to normalize interest rates. And people started celebrating victory before it had been won. The Fed was taking credit for a battle they hadn't won. But all of a sudden, the market started looking forward. Oh, everything is great. The Fed's going to raise rates. And so the dollar started to rise, anticipating all these rate hikes. Plus, people were now worried about Europe. They were worried about China. We were the cleanest dirty shirt in the hamper. So we got this big run of the dollar. Then, when the Fed finally started raising rates in December of 2015, that's when the dollar peaked. That's when gold bottomed out, right? Buy the rumor, sell the fact. And then, of course, the fact never really lived up to the rumor because we haven't raised rates nearly as much as people thought they were. And given all the talk about shrinking the balance sheet, so far it hasn't shrunk at all. So we never really had the fact to support the rumor that caused all the dollar buying. But ultimately, we are going to take out the low from 2008 in the dollar index. We're going to take it out in a big way. And I think the dollar is going to continue to fall in an orderly manner until it becomes disorderly, right? People are going to say it's a good thing, it's going to help our exports, until all of a sudden it's going to be a bad thing. Because now all of a sudden it's going to create a crisis of confidence in U.S. financial markets, and it's going to cause big increases in consumer prices, which are going to be impossible to mask beneath, the phony CPI statistics. So all of a sudden, you're going to start to see consumer prices really rising, the dollar tanking, yet the Fed stuck, at practically zero rates because the only tool to fight inflation crashes the markets and crashes the economy. Because you live by cheap money, you die by it, right? Or live by QE, die by it. If we actually have to fight inflation, that's it. They've put us in a situation where it's impossible. The Fed has to surrender to inflation. Volcker, I mentioned Volcker, he was able to raise interest rates to 20%. Can we do that today? Can we get anywhere close to 20%? We couldn't even get to 10%. We couldn't even raise rates to 5%, given the enormity of the debt we have and the way it's been financed, right? It's not financed with 30-year treasuries. It's financed with T-bills. So when interest rates go up, it doesn't just affect the money you're borrowing now. It affects all the money you've borrowed in the past because you constantly have to roll it over at the higher market rate. Well, they're going to have to print because they need to sustain these bubbles. And I think that budget deficits are going to get a lot bigger. Meanwhile, look at all these natural disasters we've had this year, the hurricanes, the fires. Where's all that money going to come from? A lot of disaster areas, a lot of FEMA bailout money, a lot of, people don't have insurance. And even the insurance companies, where does that money come from? If the insurance companies have to pay to rebuild houses, where do they get the money? They have to sell off some of their portfolio assets, so somebody has to buy that. And then, of course, they have to raise their insurance premiums, which is going to be another big negative for the economy, is going to be the higher cost of insurance. It's not just health insurance that's going to be more expensive. It's going to be property and casualty insurance. And all of that is going to, weigh heavily on the consumer. So, I think the Fed is going to be stepping it up. And yes, there are certainly a lot more people now that are long the euro than a year ago. There are some more people that are long gold now, but I would not say the trade is crowded. I think more people are probably agnostic about gold than they are long. I don't see a lot of buying. I can tell you at my gold business, our sales are off about 80% this year from last year. So the public, because I sell gold to the American public, and they're not buying. And even at my own asset management company, this is the first year we've actually had net withdrawals from my managed accounts. Even though we have great performance, both absolute and relative to the S&P, people are taking money out because they want to invest in the U.S. stock market. So if you're looking at the retail investor, they're not buying gold and they're buying U.S. stocks. I think incorrectly so. I think the optimism is wishful thinking. It's not grounded in reality. But so I see the contrarian indicator the other way. People are not buying gold when they should be. They're buying U.S. stocks when they shouldn't be. And to the extent that some of the professional traders are bearish on the dollar, they're not nearly bearish enough. There are people who think the euro can go up a little bit. They have no idea how much higher it's going to go. And it's not just the euro, it's a lot of these other currencies. So I think a lot of the dollar bears are also wrong in that they're not bearish enough. They're just sort of bearish. They need to be super bearish. So the bears can still be proven wrong if they're not bearish enough. And I think that's what's going to happen. The bulls are completely wrong, but even the bears are wrong.